let's break down 5 bullish trades that have a bullish component. Okay? So I'm going to go and just because I'm just going to pick a few different stocks here to kind of show, we're going to look at Netflix that is trading about $300 for right now. And if you were interested in trading Netflix, and I just say we're going to choose this 35 days, um, if you were going to do a covered call, okay, a covered call is actually a bullish strategy that has a bearish component. So normally a covered call looks like this, right? A call, a when you buy shares, it looks like this, right? But when you sell a call against it, a call is bearish. So that's giving you the bearish component, but you still want this to go up. It's still bullish. As you can see with these deltas on the TastyWorks platform, even though we just put on that call, we sold this call at the money here. It's still, we're still basically 50 deltas, just under 50 deltas there by selling that call. So because you're long 48 deltas, you still want it to go up. This is not a bearish trade, and you will be happy if you initiate this trade as buying the shares and then simultaneously selling the call, which is called a buy right. When you do it at the same time, then you want it to go up. If it goes down, then it's going to protect you 21 points down, right? You have a cushion because that's the credit you're receiving, that 2130 there. So basically 21 points. It's going to protect you 21 points to the downside. So it has that bearish component to it, that bearish element, but it's still bullish. And we'll kind of break that down on this curve view here. See, so this is the curve view, and this is basically the at the money line here, which it is. If it goes up, you're going to win 100% of the time. Okay, on this covered call type of strategy. But you also can win if it goes down, and this is indicating the TastyWorks platform is saying you have a 61% chance of winning at expiration. So even if it goes down, you have a 61% of chance at least to win, to make something. Not obviously this max profit of 24.55, but you will win something 61% of the time. But if it goes up, once again, you have 100% of the time you're going to win on this covered call. And so that's one of the kind of uh, bullish strategy with a bearish component. Let's look at a different one, and it's called the collar strategy. Now, the collar strategy is a brother or sister of the covered call. It's literally doing a covered call, but at the same time buying a put to kind of limit your upside and minimize your downside. So when you're doing a covered call, you are buying the shares and you're selling the call. When you're doing a collar, you're going to take some of this premium, about $2,100 that you're receiving on the put on selling this call. You're going to take some of that to buy a put. So if we took some of that and bought a put, we can literally buy a put at this 45 delta on the put side. We're not going to be able to make a lot, but we're not going to lose a lot as well if it goes up. So with this trade here, we have the potential to make 385 if it trades above two, if it expires above 295, and if it expires below 290, the worst we can lose is 120. Right. So this is a nice little trade for 35 days. If you were going to do a collar, it's still bullish, as you can see. It's not bullish a lot, but it's still bullish with this 3.36 long deltas here. But let's just say you wanted to have a little bit more upside. So you could do something like this and move this put to the 280 strike or the 38 delta. And so now you had the potential to make up to 830, and your deltas are a little more. You're a little more positive. You're about 10 deltas positive. And the most you can lose if it goes down is 675, because this put that you buy is protecting you to the downside. You cannot lose anymore after 280. And the reason why you can't, because this put represents 100 shares. You own 100 shares when you're doing a collar. So it kind of offsets each other one for one after it goes down past 280. So you can't lose anymore. So this is a powerful kind of bullish strategy to use if you are bullish on something but you're a little nervous. You can initiate as a collar, or if you already have on something like a covered call and you're about to sell another call on those shares, against those shares, you can, instead of just doing the covered call, you can also turn it into a collar to kind of protect yourself to the downside if you believe you can. It's more downside risk, right? But you can still benefit as it goes up. I'm showing you aggressive. We showed you aggressive cover call by selling at the money, and I'm kind of showing you an aggressive collar by not allowing it to fall very much. But you can play with the strikes. You can always do things like this to figure out how you want it to play out and so forth, right? But I like on initiating the trade or trying to really protect myself, I like something like this. And this is called a collar strategy. It's also bullish, but has a strong bearish component to it. So that's the collar. And then if we break this down and kind of do a broken wing butterfly, and you guys heard us talking about the broken wing butterfly in a while, that also has a bearish component the way you set it up. So for example purposes, let's just say I decided that I was going to buy this 31 delta and let's say sell this 260 strike, and then buy, let's just say 20 points lower, something like that, and do two contracts at this 260, because that is the bear. That's the bullish component of it. All right, so, and that's the butterfly. So a broken wing butterfly is when the wings are not equally apart from each other. So for example purposes, right here, this is 10 points apart. And if it was a traditional regular butterfly, this right here would be 10 points apart. But you can see that it's not. This is 20 points apart. Okay? But this is the wing, this is the body, and then this is the wing of the butterfly. And the broken wing butterfly, it just means, okay, we have 10 here and we have a 20 point wide there. Okay? But this has a bearish component to it because this part right here is bear. It's a bear kind of put spread inside of this, right? Right from here to here, it's bears, and then from here to here, it is bullish, right? That's the bullish part. And the reason why this is net bullish, as you can see with these deltas here, not a lot, but it's still net bullish, it's because of the credit you're receiving is going to make it bullish. And in this case, you're receiving a credit of about 127, and then the buying power that's required on this one is a lot less, is 870. So that means you're receiving 12% on your buying power when you're doing something like this. When you're doing a covered call or a collar strategy, it's darn near impossible to get 12% return on your capital on that type of trade, because it costs so much to get the buy the shares, and that's associated with a covered call or a collar strategy. But in this case, you're not using any shares in this broken wing butterfly, so you can structure it in a way that it actually gives you a really good return on your capital. Okay. All right, so this is how this is set up. It's bullish. You want it to go up. If we take a look at this kind of curve view, you can see that this right here is the at the money. If it goes up, you're going to win 100% of the time. If it goes down and land in between this long leg and this short leg right here, you can actually win more on this broken wing butterfly. As you can see here, you can win over $1,100. But if it goes up, you're going to win. If you hold the expiration, you have a potential to win is $129. You want this to go up. It's a bullish trade with the bearish component, but you can actually make more money if it goes down. You do not want it to go down. Don't be mistaken. You do not want it to go down, but if it does go down, you don't want it to go down a lot. And if it doesn't go down a lot and it kind of lands in between this short leg and this long leg here, you can make more than the credit. Okay, you can make more than the credit. So TastyWorks is saying this is about a 77% chance of winning at expiration, and you got over an 80% chance of winning if you get out at 50% profit on this broken wing butterfly. Right? So the next type of strategy I wanted to talk about, we kind of went over this a little bit this morning. It's called a bullish bear strategy, and it's similar somewhat to this broken wing butterfly because it has two components to it, two type of trades, a bullish and a bear part to it, and it's you can make more money than the credit you receive. So for example purposes, if we bought this 31 delta put spread, and then we went down here, and I just say we bought this 19 and this 19 put and bought this, and I'm talking about the Delta Wise 19. And then let's say we did two here. Okay? We did two here, and you can see that in this scenario, we haven't got two yet. There we go. All right, so in this scenario, we're receiving $215 credit, and this market is really coming down a lot. It's now inside the expected move. Unfortunately, we waited too long to be able to get a nice little trade on, but we're going to do it anyway still. All right, so you got the 12.15, and then you have this is the credit you receive, and then you have the max profit that you can receive on this. And the reason why is because this is the bear component of this bullish bear. Okay, and so this is a bear put spread, so that means you can make as much as $500 on this before the premium you pay for it. And then this right here is a bullish put spread, and we have two contracts, but for one it's a 10 point wide, so you got the 10 time 100, so the most we can lose is $1,000 times 2, or $2,000. That's the most we can lose. But if you break this down, we're receiving a credit of 215. You got this bear part of $500. So the most you can lose on this instead of 2,000 is about just under 1,300. Is 1,290. There's 1,290. Because of this bear component, right? But if it lands in between here, this is where you can have more, you can win more, up to $716, right? But you still want it to go up. This is a bullish strategy. As you can see right here, there's almost 6 deltas. You want it to go up, but if it goes down and land in this area here, you can actually make more. That's the kind of the bearish component to it. All right, so if I go over here and I look at this is the curve view. This is the after money. Once again, if it goes up, you win 100% of the time. If it goes down, you can still win almost 80% of the time. With TastyWorks is saying at expiration. But if it falls in between here, this long leg and if it falls in between this short leg and this short leg, you can actually win as much as 712 on this bullish bear strategy. Okay? All right, so that's the fourth one we wanted to look at. Now this fifth one is a little bit more advanced, but we're going to do it anyway. And it's hard to put this on the curve view, but if we're going to go into a micro future option. Okay, and this is the ES micro future. It's the same thing, as you can see, as the regular ES future here, but this is a smaller version of it. This is the micro future. Okay, and the ES is $50 a point. This right here is $5 a point. So it's 10. It's only a tenth of the size. And if we were going to be long it, we would have to go up here on the TastyWorks platform and click on the price under the ask. Okay. And so this is buying the future. If it goes up, we will make $5 per point. And if it goes down, we would lose $5 per point, right? If we just bought this micro future, right? And this is saying right now the buying power for it to buy this micro future is going to be 364 on this account. In your account, it could be more. Okay, it could be more, but I'm going to show you how to make it less regardless. And so let's just say we have a short-term bias that this market's going to go up, and we have and so we would take this micro future and then pair it with a micro option to give that bearish component. So for example, if I bought this option here, right? If I bought this option here, that's going to give me the bearish component, because this is buying of a put spread, which is bearish. Okay, and so now you can see that the buying power is only going to be 123. So we dropped it by about $200 in this account. You might drop it significantly more on yours, but it's still a bullish strategy. You still want it to go up, but since this is a 50 delta, basically, we're cutting the win, the amount we can win per upwise, for at least initially, to instead of $5 to $2.50 every time it goes up. Okay, so that's what we're going to do right now. We're going to buy this. We're gonna buy this part first, because we're gonna buy this put first, because it's easier to get. It's harder to get into. It's harder to get into the put. So we're gonna buy that put first, and then we're gonna buy this, and we're gonna send that. So so now we have on a bearish component of this, and you can see this is the micro contract here, and so far we paid a little bit to get in the trade, and it's basically flat to down, as you can see here. And so, but we want this to go up, and if it goes up, then we're going to make money. But we're going to bet $100 on this. So if we're down $100 overall right here, then we're going to say uncle, but we're going to let this play out, betting that because the VIX is telling us that we're down big the last 2 days, this VIX is actually going down. As the market goes up, that's giving me an indication that the market is oversold. It might go up on Monday, and the volatility, I mean the futures VIX is telling me that as well. The Nasdaq VIX, this VXN, is also telling me that, and all of this is down for the second day in a row. So I'm betting, okay, this short-term trade, we're going to be able to go up on this on Monday. It's just a pure directional play with a bearish component to this micro future paired with a micro option. We want it to go up because we bought the future. That's bullish, and then buying a put is always bearish, right? So we can't lose more than what we paid basically for this trade, because of this bear component. If it falls a lot to the rest of this trading session, or if it falls a lot on Monday, we're going to be perfectly fine, because we bought this put. Okay, we bought this put at the money there. So we're gonna let it play out and see how it
first.
Say that again.
Buy the micro future first, and then put the.
I bought the put first, because it's usually harder to get into that, and then it's easier to get in and out of the micro future. So I bought the put first, and then bought the micro future. And then when you get out, you want to do the same thing. Get out of the option first, and then get out of the future, because it's always easier to get out of the futures contract than the option. Okay, the futures contract is up here. Okay? All right, so you can if you were interested in doing that trade, you can get it potentially a little better than what I did to this point, but we'll see. It's basically flat. I like it. This net, this $200 is basically what we paid for the trade. So if we're down $100, we're gonna lose. That's, basically paid $100 for the trade, and there we go. So we're gonna see how it goes. We got another 35 minutes left in the trading session. We could go back to our lows, and if that's the case, that's fine. I'm still gonna hold this, because the odds on me being down more than I want to be today are very, very slim. Let's say, because if we go back to the lows, let's say we go down 30 points, right? Well, we're gonna lose 30 times 2.5, right? So that's $75. So that's the most we can lose in today if we go down 30 points. And if it goes up 30 points from here, that's the most we can make on this trade. We're not trying to make a lot. Obviously, we're not trying to lose a lot in this scenario with this type of trade. All right, so let's now go and look at a short-term 1 DTE trade.